Hello everyone, how's it going? Today I'm going to go over a strategy which is a volatility relative value one, which plays the range of one underlying versus the other. So basically an overview of this trade is we want to sell an iron condor on one underlying and buy an iron condor, so do the two debit spreads on another underlying. We want this to be the same expiry date, and we also want to make sure that the net credit from selling the one condor is greater than the net debit paid to buy the other condor. And we also want a situation where the maximum profit of the debit condor is greater than the net credit one. Now, I know that's a lot to say, but I'm going to work through an example here. So let's say we wanted to do SPY versus TLT. Let's do options on equities versus options on bonds. So here's a daily chart of the SPY. Let's say we think this range-bound recent momentum of the SPY is going to keep it within range. So let's say our top is going to be 760 and our bottom, we'll say 725. So that is our range here. If we go to our options chain, what we would do is let's go about 21 days out. Now I want to make sure we have the same date, so we both have a 21 for both underlines. So let's go 21 days out, and if we sold a 725, and we're just going to do one condor, and we're going to hedge 1 point out, and we sold a 760 and hedged 1 point out, we would have a trade, and let's look at the economics here. So we'd have, let's ignore the credit here, we would have a credit of $44 and a max loss of 56. So our account would be credited $44, and if the SPY broke outside of that range and traded above 760 or below 725, we would take a $56 loss. Now the next thing we want to see is on TLT, we want a range we think it's going to break. So our thesis here is, let's say we believe that bonds are going to break out of the range. We want to create a position on the same date, 21 days out, that has the economics of we pay less debit to enter the trade, and we have a greater maximum profit than the max loss. So we want our maximum profit to be above $56, and we want our net debit to be below $44. So let's say the range we think it could break out is 87.50 on a rush to bonds, or maybe some deflationary pressure in the labor headlines. And let's say $83, and let's say that's like an energy shock or whatever. Let's just say that our current thesis, and this is hypothetical, is that bonds are really susceptible to inflation or deflation news, depending on if labor or energy takes the narrative. We'd go to that same thing, and let's go to TLT, and same date, 21 days out. Let's buy, and we're going to do a point out just to make the economics similar. Let's buy the 83 and sell the 82, and let's buy the 87.5 to sell the 88.5. And on this position, what I want to see, because we're doing one each, is we want to see that net credit, and we could ignore the fees here, to be less than 44, and our maximum profit to be, our net debit, to be less than 44, and our maximum profit to be over 56. So what is the situation we have here? Our max profit is 90. So that is $34 above our max loss. That meets the first one, and let's check our net debit. So it is a $10 net debit, $12.64 with fees to enter that trade. So if we pretty much entered a situation where we sold that first condor on the SPY, and I'll overlay, and bought on the TLT, on the same date, what we would essentially have is a trade that would profit in these situations. Our first situation is if 21 days out, if we, you may not hold until expiry, but let's talk about expiry. If 21 days out, SPY and TLT stay within their two ranges, so it stays within here and it stays within here, we collect the profit, which is the credit minus debit paid. So it would be $44 minus that $10 debit, or $34. If we have a situation, this is the max profit situation, where SPY stays within its range but TLT breaks out, we collect the max profit on the debit spread plus the credit from selling that. So that would be 44 plus 90, that's $134. So you can go from making $34 with both staying in range to $134 if the TLT breaks outside of its range, and SPY does. But an issue is if SPY breaks out of its range and TLT stays within its range, we take a loss, which is the $56 max loss on that Condor 21 days out, and the $10 debit paid to enter that long Condor, which is a $66 loss. So you have a situation where you can make a little bit of premium, make a lot, or you can take a pretty kind of medium, large size loss relative to the position economics if this stays within range and this stays without range. So that's why sometimes you may even add a third leg, such as the NASDAQ, fourth leg. But here I'm just going to talk about two positions as a cross relative value. And this is a trade I find really essential on macros. And before you enter it, what you'd want to do is definitely look at pair correlations. You would want to be looking at TLT versus SPY, and you would be wanting to look at its pair correlation. You wouldn't want, in this situation, there to be too roughly positive or too roughly negative. You want both markets moving quite independently. As you can see here, we are at only negative 0.1378, moving to 0. So this is actually a time where the pair is becoming less and less correlated. Sort of a cross-asset iron condor trade would be ideal. Anyways, thanks for listening, and I hope y'all have a great rest of your day.